up, Zinger Nation? Happy Tuesday. Welcome back to another episode of Benzinga Live. We've been every Tuesday been bringing Ryan Pannell from Kaiju on talking about AI, and we are going to do the same today. Although, it might start looking a little bit different going forward. Hopefully, we're gonna be able to bring some more value to you guys. So we're gonna talk about some of these changes today. Hopefully, you guys will be able to leave some feedback in the chat. Let us know, what you guys like about these segments and maybe what we could do differently as we move forward. Before we bring Ryan on, though, and discuss those changes, I do just want to do a quick market overview. Obviously, since we did the show last Thursday, a lot has happened throughout the world, and we will talk about that later in the show. But you can see right now, I'm on the 5-minute chart for the S&P 500. Market responding positively today, up 0.7%. This is mostly on the heels of kind of the rate, the treasury yields starting to level out, starting to fall in some places. But the bottom line is, unfortunately, and we can talk about some of these reasons, the market doesn't hate times of like geopolitical unrest. We saw this in the Russia-Ukraine invasion here. Let me keep the SPY up. We'll go to just a daily chart. If you guys remember, there was a lot of speculation kind of leading up to Russia's invasion of Ukraine. The way troops were being positioned around borders, a lot of people were basically wondering, okay, is Russia going to invade Ukraine? And in these times of uncertainty leading up to it, the market was trading lower. But then the day that it actually happened, the market spiked, went up a bunch, and then traded, up that week. And again, because there was less uncertainty that at the time before. Hold on, I don't know what's going on with this chart. Gotta fix this. At the time leading up to the Russia-Ukraine conflict, there was just a lot of uncertainty, and the market doesn't like uncertainty. It would rather know for a fact what's going on, that the war is going on, rather than not know, if it's going one way or another. Hold on, I just gotta find the day. What day did Russia invade Ukraine? I want to say it was like February. Thursday, February 22nd. Or no, Thursday, February 24th, 2022. Okay. So yeah, you can see it was right here. Oh, no, not right there. Yeah, right here. This big green candle was the actual day. Market looks like the market closed up 1.5%, but it had got lower than that intraday, and then spiked up. Then the next few days continued to trade higher, and then a little later on took a dip and then went back up. So within a month of Russia's invasion of Ukraine, the S&P 500 had, the day of it, had hit a low of 428. Within a month, it was trading up to 462. So again, we can talk about why this is and talk about some of the things, but I think a lot of people over the weekend were anticipating the market getting crushed on this news, because obviously it's terrible news, and but that's not been the case. And again, we will talk about it. But all right, let's go ahead and bring on our guest of honor of the day, my man, Ryan Pannell from Kaiju. Let's go ahead and roll that Kaiju intro. When we come back, we'll be talking about our new Kaiju segment coming to you next week. What is up, Zinger Nation? Welcome back to another episode of Benzinga Live. Happy Tuesday, everybody. All righty, let's bring on my man, Ryan. Ryan, how we doing today?
Good. How you doing, Aaron?
I am great. So, Ryan, we've got some exciting.
I like it.
What'd you say?
Thank you. Guest of honor. I like it.
Yeah, come on. Every Tuesday.
Wasn't doing anything right now at this point in time. That's should be right up here in the Chiron.
Well, I agree. So we've got some exciting changes to these Tuesday segments to share today with our viewers. So starting next week, each Tuesday, Ryan and the team Kaiju will come on and share insights and tips as professional traders, portfolio managers, leading creators of AI trading systems, and asset managers overseeing more than $500 million in mixed assets right here on this show. Ryan, can you explain kind of what made you guys decide to take this show to the next level here, and why kind of these future segments might be a little bit more valuable to retail traders and investors watching the show?
Sure. I mean, I've enjoyed the last couple of months coming on here and just, shooting the breeze with you on AI, talking about what's new, trying to, give some context to a very fast moving technology that's surrounded, a lot of doom and gloom, a lot of maybe promises, lots of disappointments, ethical concerns, etc. It's our bread and butter here. We've been in this space for a long time, so it's fun to do. But we started to ask ourselves, for your viewers here, okay, there's like a handful that maybe have some interest in hearing what guys who've been working in this space for a long time have to say. Maybe we can dispel the odd myth here and there. But if I press the long rewind button on my own life back to when I was sitting in that chair, if there was a show like this, like there wasn't when I started in retail, there was like bulletin boards and instant messengers. But like what was I looking for? I wasn't wanting to listen to a bunch of guys pontificate on their knowledge and how cool they are. Like I just wanted somebody to tell me how to improve my trading outcomes. That's what I really wanted. Like it didn't matter. Tell me a place that I can find more accurate information. Dispel some myth that I had that I didn't know was costing me money. Certainly not give me a stock to trade. I never asked that question, but just guide me in terms of how do I build scans that help me find what I'm looking for more efficiently. And, we do this every day. Yeah, fine. We work in artificial intelligence, but we use AI to build trading strategies. And we have, a huge cohort of data scientists here that are all PhD mathematicians that have been working in AI for a long time. And we have really experienced traders. We have an incredibly experienced, diverse trade team. And these two groups work together all the time. Like AI is not making the traders obsolete. It's empowering them and making them more efficient. And the traders have years of experience that assist the AI team in building strategies that are reasonable to assume can deliver, right? Like none of these guys are traders. So, we pack that all together and we ask ourselves, like, how can we be of value here? Because I don't have anything to sell your viewers. I mean, I guess that's not completely true. We do run on ETF, but I mean, on the private fund side, on the trading strategy creation side, I don't have a course. I don't have any books to sell. Like there's nothing that I can drive these guys to. So if we want to provide value, we could just start sharing it. And, my trade team was really excited about it. You've had Nicholas Sobrian on before. He's super excited about coming back. David Schooley, who's our chief technology officer. You've got a guy that has built or supervised the building of groundbreaking systems for like the past 20 years for Sabre and Sands and companies of that caliber. You want to know how you can potentially use AI or what it takes to integrate AI in your processes, your investment management processes, your trading, etc. That's the guy to ask. So, that's what we wanted to start doing. Just like providing actionable things every Tuesday that hopefully, help the viewers with something, ideally outcomes.
Yeah, and so guys, in the chat and in the audience, please let us know what you think of this, plan to kind of, I guess, shift the content more toward the professional investing, how money is managed, and these kind of trading behind the curtain things, as opposed to focusing more on the AI aspect. I mean, I know you guys have probably been, inundated with so much AI stuff throughout the last, 10 months or so since ChatGPT really took off. But Ryan, one thing I'm curious about is this going to be a bunch of tips and tricks for trading, or are you going to be providing a more comprehensive behind the curtain experience for our viewers, where again, kind of, pull that curtain back and really see kind of how some of the sausage is made, for the lack of a better term?
Yeah, for sure. Yes to the latter. So if you were interning on the floor somewhere or on somebody's desk at a large buy or sell side institution, you would get exposure to this information really early from the very beginning. And when I say information, again, just to dispel the myth, like there's no secret reservoir of good stock tips that we have access to that you don't. It's not that kind of information. It's the structure around how these trading systems are used everything from what signals you see that you think are meaningful, that probably aren't meaningful, that you should be looking for, that could be meaningful, how to structure your orders. I mean, trade execution is a huge part of this game. You can't just fire off market orders and hope that that's going to work out. So understanding, how to use more complex orders that may be at your disposal that you don't even know are there is something that we all learned that, no one's going to offer up. And the only things that I've seen providing any kind of education are guys, quote unquote gurus that are trying to sell a program, a newsletter, a masterclass, or whatever the hell it is. Only they've never done this job. That's the killer. It's like, I'm the retail trader who is floated to the top. Here's my Lambo and my yacht and my cool penthouse. But what you're really seeing is the outcome of really successful marketing more than trading. Quite often, these guys are front running low float stocks and predating on their own subscribers. It's like they were there last week. They pumped some 34-cent low float miserable dog of a stock. You pump money into it, it bumps it up. That guy cashes out. And it's like, here's what I made. Here's what you can make too if you follow me. We just, we like to provide some of the professional education. And in the vein of AI as well, we're not going to stop talking about it. It's here. It's a huge part of this business and becoming larger day by day. But, for you to take advantage of it or not be taken advantage of by it, you need those fundamentals. If I try to tell your viewers how not to get run over or predated on by AI taking advantage of order flow imbalances, you have to know what an order flow imbalance is. That might have just sounded like complete nonsense, what I just said. I just made that up, right? And so if you know that, you will know how to steer clear of these systems that are for sure coming for you on some level and take advantage of them when they're working in your favor. So that's the idea here.
100%. I love that, Ryan. I mean, I think it's one of those things where, you hear a lot of those terms, like you said, whether you're talking about order flow, and for most people, they'll just go over their head. They'll never know kind of what it means. So to have someone like yourself, who's coming from the industry, who's done this professionally before, I feel like that's some kind of invaluable experience that we get to tap into and kind of pick your brain on. And so, guys in the audience here, I mean, I hope you guys, realize that an opportunity here, you guys can ask questions in the chat, etc., and hopefully we can get to some of these things. And then, Ryan, so given the focus on everything from trading basics to tips and secrets of the pros, where does AI fit into all this going forward? I assume we're still going to talk about AI in some capacity.
Yeah, absolutely. And as I said just a second ago, for your average retail trader, retail investor, AI is being used on the execution and order flow imbalance predation side already. That's already happening. It's taking the processes that HFTs have been using for the past 15 years and making them far more efficient. And that's something where, if you don't understand that process, it's like walking into a meat grinder, right? I mean, I'm sure everyone who's watching this has been, whipsawed intraday, and 2 minutes later, 60 seconds later, you were right. You did your analysis, you timed your entry, you walked into a blender, you got stopped out or destroyed in some way. And 2 seconds later, what you thought was going to happen actually happened. And so you weren't wrong. Your analysis wasn't poorly executed. You're probably tearing your hair out, but the reality was you walked into a flow imbalance that you couldn't see. You didn't understand what you were seeing in that context. And if I can help you identify that and understand how AI is already manipulating that and going to continue doing so. And by manipulation, I don't mean in the dirty edge, dark side of things. I mean simply very, very good at processing those liquidity pockets and voids, those predation opportunities, those flow reversals much faster than a human can. So just like you can get blended by being on the wrong side of that, you can catch a fantastic wave on the other side of that. If you trade with overflow conditions in your direction, like you'll be past your critical stop in 60 seconds, 2 minutes, something like that, and like, whoa, I was right, and I've surged up here. And that's where we're going to start looking at AI, where you can understand how to use that, and where you can understand, if you're a fundamental trader, I mean, we are not, but if you are, then using some generative AI technologies can help you find the key information you're looking for a lot faster and with greater ease. So if we can share with you prompts that you can use in GPT that will help you collect information faster and more accurately, then we're going to share that. Like that is not secret sauce that anybody has any need to keep to themselves, in my opinion. The information is public anyway. We're just telling you how to get it faster and easier.
Yeah, I love that, Ryan. And I guess I gotta ask, because this has been probably my favorite part of these segments over the past couple months that we've been doing this. We got to keep the kaiju kicker right at the end. So if you guys are new here, we've been doing a kaiju kicker at the end of every segment, where Ryan will leave us with a tip from the trading world that's that's usually this type of actionable piece of advice that you can actually take away from and use it in your daily trading life. So Ryan, are we going to keep doing that going forward?
We're absolutely going to keep doing that going forward.
Good.
We're going
Okay.
to make sure that every segment has one or more actionable suggestions that you can take advantage of, and we're going to try to build on that. I mean, the cool thing is, after we do this live, you guys at Benzinga post these little segments on YouTube. So if you miss one, you can always go back and watch it later. And so as we build from where you can fill gaps in your trading education, what you might want to read or better understand in terms of solid trade execution fundamentals, information gathering mechanisms, and then understanding, flow, NBBO, mispricing, or huge spreads, and where that's dangerous, where you might want to use options, hedge, non-hedge, primary, tertiary, whatever. Like, we'll work through and build on that. And if you miss something, you can go back, check it out. But the idea is to make sure that we keep growing the foundational education, so that as we start to talk about more complex things that you never see show up in a retail chat room, volatility surface models, like our vol guys will come on here and talk about options trading until you're all bored to death. But these are guys from Peak Six and Spot that have run $40 million portfolios before. So their perspective on the best way to structure what you're trying to structure is super valid. I'm sure, Aaron, when you started, right, and probably several decades later, probably the same way I did, the first thing you're looking for is what books should I read, or what websites should I subscribe to, newsletters, chat rooms, whatever. And there's a double-edged sword when it comes to some of this stuff, right? I mean, I'm sure you have come across a huge amount of misinformation. Maybe you didn't know it then, but you surely know it now. And not everything is Benzinga. Benzinga is a good source of information. The people you have on here are not full of it, but you can't be everywhere all the time. That's something I can imagine you would have loved to have access to.
Yeah, 100%. I mean, like you said, you come across a lot of the misinformation, and the problem is you don't realize it's misinformation until in hindsight, because in the time you're like, oh yeah, that makes sense. Then you go out and use that in your trading or whatever, and then I think, as always, the best way to learn is through doing it yourself. But you want to find the people like Ryan that are coming from the professional world, that know what they're talking about, to help you on that journey. Because if you're just listening to any schmuck out there online, then you're probably not going to have a great time.
Well, you'd have no idea, right? I mean, it sounds like it might be good. I mean, the one thing that I'll leave, if we're going to do a kaiju kicker today, what I would
Beautiful.
say is the perspective that I would urge anybody who's watching this to look at their portfolio from, and your more experienced traders already do this for sure, but newer traders tend to look at a whole bunch of discrete opportunities. individual stocks that you hope will go up or that you can short, and you're looking at them through a single lens. And on the professional side, we never do that. Nobody does that. The portfolio is constructed holistically. That is, it's designed to operate as an entire multi-layered basket of complementary assets in different directions. We try to build it market neutral and directionally agnostic so that, yeah, you make money when the market goes up, you make money when the market goes down. There are opportunities out there for everything. You have a bias and you lean towards that, but it is a holistic construction. And that's why you're never going to get a stock tip from a professional. And even if you did, it wouldn't be useful to you because, like if I gave you a screenshot of our current Vollard positions, if I was allowed to do that. So I take a screenshot from Bloomberg, I just post it here. Here's what we're doing. First of all, unless you have the same capital base, you're not even going to be able to trade all of these things. Second of all, we have very specific goals with respect to targets, volatility space that we're looking at, and these may be totally wrong for you. So you could trade all of the same stuff that we've got going here and get a completely different outcome. And you're like, wow, these guys gave me the worst tips in the whole world. Well, because they're not designed for you and your portfolio. They're designed for this fund, this portfolio within the fund, etc. So I hope that by the end of this, we can have built this sort of foundation such that you guys are constructing these, more holistically incepted and conceived portfolios. And then we can chime in with stuff that retail always struggles with, like hedging, and I'm going to bring on the trade team to do that. Like our chief PM, Mark Shu and Matt Velotica will come on. They're awesome guys. You talk to guys with like decades of experience, running these big options portfolios and, pick their brains. So hopefully that's useful.
No, I'm excited about that, and I think it'll be interesting to get some other people, other perspectives on as well, Ryan. So, should we transition into today's Kaiju Kicker, kind of the last segment before we come with the new look Kaiju Benzinga show next week?
Sure. I'll just add on to the holistic portfolio and why there won't be any stock tips and why you shouldn't look for stock tips. And that is that I think the most important thing for a new trader or a trader that's trying to find what works for them to grasp is there's no one way. I mean, you're more experienced guys watching this already know this, right? There's an almost unlimited number of perspectives. There are an almost unlimited number of viable timeframes. Please don't trade intraday. We don't do that. And I'll get to that later and talk about why, but certainly like close to close, totally viable. Absolutely. And because somebody's making a lot of money doing something one way does not mean that you should feel bad that you're not able to do the same thing. And I'll leave you with just a little anecdote from my own existence. When I was running a small hedge fund to start, and I met, over 10 years ago, our chief technology officer, David Schooley, he was a prop trader at the time. So I was the pro trader, he was the prop trader, and we just sort of communicated on instant messenger. We worked in different spaces, different parts of the world, and different firms. And, we would just talk about, well, what do you see here? Can I get a second opinion on this? We didn't overrun each other's stuff. And David, he probably deny this if I said this, but he was a way better stock picker than I was. Like, for sure, hands down. Like, almost everything he put on a watch list just was like an ATM. And he was less profitable because he didn't execute with the same level of veracity that I did. I was slightly less accurate than he was, but I was decisive. And so what would happen is, 3 or 4 weeks would go by, he'd share his watch list. It was like, oh my God, man, you're killing it. That's crazy. Like, you're up 8.5% in 3 weeks. And he's like, yeah. I didn't trade any of them, but yeah, they were good picks. And I would say, what do you mean you didn't trade any of them? Like, you did all the analysis, you put it on a watch list. You didn't pull the trigger? No, I didn't pull the trigger, right? And that's like, ultimately, I shared some of my analysis with David to kind of, build some more confidence because he's so smart and he was so good at it. It's like, okay, I just need to shove you a little bit. but that was just not his style. That was not his bailiwick. He just didn't, and shoving him that way didn't help. He didn't enjoy it. It increased his stress, even when it was profitable. So my takeaway is spend some time experimenting with different time frames, different asset types, use minimal capital, use paper trading, especially with something like Worden or at IB. The executions are pretty accurate on the paper trading side. And keep an open mind to, if you're struggling, if you haven't found your thing yet, it's not because you're a terrible trader. It's because you may just not have found your thing. Some people are really good position traders. You're adjusting your portfolio Sundays and you are doing analysis once a week, and that is it. And you're in the 3 to 6 month time frame. I'm not a good position trader. I never was. I was always a swing trader. 3 to 8 days. That's my shtick, and that's where I went. So open mind, and we'll cover all trading strategies. We'll cover all types of traders. And if you have questions, there'll be somebody here from each discipline that can answer them for you.
That's awesome. I think that'll be very helpful because we have people, that might be more long-term focused for people, that are swing trading versus day trading. So it'll be interesting, Ryan, to talk about all these different things. I'm excited for it. I know we'll be talking off air about some of these things. So again, super pumped to bring this new look Kaiju show next week. And as always, man, thanks again for hopping on with us today.
Happy to be here, and looking forward to kicking this off next week.
As am I. All right, guys, that was Ryan Pannell from Kaiju ETFs. We're going to go ahead and drop those links in the chat if you want to check them out. And again, next week, make sure to tune in because we'll be doing kind of a new type of segment with Ryan. We'll be discussing more kind of from the trading and wealth management side, portfolio management side, as opposed to talking more about the AI. So hopefully some more just insights, tips, things you can learn, some content that hopefully the whole goal of it is to basically be like, hey, here's something that I learned from people who have traded professionally, invested professionally before that I would have not known had I not tuned into this episode on Benzinga. So again, make sure to tune in next week. We will be giving you guys some kind of, behind the curtain, inside baseball, whatever you want to call it. It's like when you, it's like if the chef at a kitchen brings you back and teaches you or shows you how some of the stuff was made. Well, I don't know if you always want to do that, depending on the kitchen or the chef, but in this case, you do. But all right, let's go ahead and pull my Benzinga Pro back up. Going to just take a look at the S&P 500 here. We mentioned this before Ryan came on, that the market, for whatever reason, I'm not saying the market's up because of the war going on in Israel and Palestine, but it's whatever it is, it's not deterred by it today or yesterday. You can see the market reaction on the daily chart here. Let's go back to the 5-minute. Just while we were talking to Ryan, the market continued to move higher. I mean, this is about when we brought Ryan on here. SPY was at 435, and now it's above 436. So it had continued to tick higher over the last 15 minutes. Looks like starting to maybe top out a little bit here. We'll continue watching that. Of course, anytime there's a big major global conflict, which to call what's going on over there, that would be maybe an understatement. Anytime there's a big major global conflict, obviously defense stocks become under the microscope. You've got LMT, Lockheed Martin, RTX, formerly Raytheon, is now just RTX Corp, Northman Group, what NGP? How do you say it? And then either way, so basically today, the defense stocks aren't getting the same pop as they did yesterday. Yesterday, they all got kind of a big pop after the escalation over the weekend. But here's what I'll say about these defense stocks is if you think that what's going on in Israel right now is going to lead to more and more major conflict, there's some people out there that, oh, this is the start of World War III. First of all, look, I mean, people said that about Russia and Ukraine. People said that when shoot, I'm forgetting the guy's name, but anyway, there's always been a lot of talk about, oh, this is the start of World War III, etc. Israel and Palestine have been fighting for many, many, many years. This is different, but at the same time, it's in line with what's been going on over the past 30 years. This has been a bigger escalation. There's more risk this time around that neighboring countries, that other powers get involved. 100%. I'm not trying to minimize this situation. I'm just saying, do we all need to go out and start freaking out and calling it World War III? No, not necessarily, not yet. And I think the market's kind of showing you that today and yesterday, that they're not as worried about maybe some of the major type of implications. But here's what I was going to say about the defense stocks is if you do think this is going to lead to more, unrest over there, then honestly, these RTX and Lockheed Martin are probably buys. We can see how these things traded. We just talked about it was February 2020. It was February 24th, 2022. So right here, when the Ukraine-Russia started, the stock spiked up a bunch, traded down, then went back up higher. So April 20, a couple months after the invasion. Still, though, the initial pop was basically kind of at its highest point, and then is now trading significantly lower. This is Raytheon or RTX, significantly lower. I mean, this was at 105. We had this pop at the Russia-Ukraine war, and now we're all the way down to 73. And that's why I'm saying that if you already think that what's going on in Israel and Palestine is going to be a tailwind, going to be a positive catalyst for these stocks, then they're basically already on sale, and you have this potential tailwind at the same time. So I don't like ever anytime, trying to make trades based on, these types of things like wars, or sometimes people will buy gun stocks after mass shootings and school shootings because they think, okay, this is going to put more pressure on people to try to ban guns. So people are going to go out and buy more guns. I'm going to buy our stocks. I hate trades like that. I hate any trades where, you're trying to make money off something that's awful happening to other people. But that said, you gotta. I mean, at least I have to. We gotta talk about the market's implications of some of these things. So I'm personally not gonna go out here and buy Lockheed Martin or RTX or anything like that. I don't think it's that crazy to think that these stocks will be trading higher a month from now than they are today. So, we'll definitely be continuing to watch them. Let's go back to SPY real quick. Looks like back on the 2-minute here. Looks like we are ticking back up now, right at the highs of the day. So, curious here to see if we can kind of take out this 436.50 level. Oh man, EKS, that's awesome. EKS says he's been using Google Bard AI to help kind of break down some reports, some 10Ks and 8Ks from companies. I might have to start doing that. EKS, it sounds like a great idea. See, my problem is I would have to go line by line, word by word, and check everything on the first 10 go arounds before I trusted it to do it without me having to check absolutely everything. Another thing I wanted to talk about today. Oh, actually, here let's start with this. Last week we talked about gas prices. I basically said hey, if you want to watch, if there's one thing I would be watching, or if there, I wouldn't say that. Not that this is one thing I would be watching, but one of the many things I'd be watching right now to try to get a gauge on inflation. And so a week ago, gas was at 380. Today, it's 360, 368. That's a significant drop week over week. A month ago, 382 to 368. A year ago, 392 to 368 today. If you don't think that's good, if this stays like this low at around less than $3.70 a gallon, or continues to move lower, this is the national average gasoline prices, then that will have a meaningful impact on inflation. And we can look at the next month's CPI projections and all these things. But higher gas prices over the last couple months have been one of the things that have kept inflation elevated. So the theory then goes, if those gas prices start to fall, then theoretically so will inflation, which, that basically, if we continue to see inflation falling or we see inflation start to fall again, then the Fed can finally start talking about rate cuts, and then that's when the market we can really get going here. But all right, let's go back to Benzinga Pro. Oh, shoot, almost screwed up there. So we just talked about the defense stocks, right? Lockheed Martin, RTX, and those stocks have gotten beaten up pretty severely over the past few months. There's a number of different industries, stocks, sectors, you name it, that have gotten beaten up. And I think it's time to at least start looking at some of these sectors and purchasing them. And we'll go through some of them here in a second. And one of them that's been really getting crushed over the past just couple weeks has been the kind of consumer staples, your Pepsis, your Coca-Colas, stocks that are typically pretty stable. Your Johnson and Johnsons, these types of stable dividend or earning stocks. Like, for whatever reason, they've been getting absolutely crushed. And Pepsi specifically, Pepsi came out today and said that they're not seeing an impact from weight loss drugs like Ozempic and other things like that, because that's been, I think, one of the things that's really been driving Pepsi's and Coca-Cola stocks down, are these fears that, okay, people are going to be drinking less soda. People are going to be eating less chips. People are going to be eating less cookies. And Pepsi, I don't think Coke owns a lot of like food stuff, but Pepsi obviously owns Frito-Lay and all these different types of snack companies too. So if there were actually this meaningful downturn in snack spending, soda spending, etc., you would expect that to be pretty evident in Pepsi's earnings. You had Walmart kind of come out and give these warnings about this a couple weeks ago. I was speculating that, I don't really know. I mean, is it plausible or possible that Walmart is kind of leaning on this as a type of an excuse to say, okay, our sales are going to be down this quarter. Let's make it about Ozempic instead of saying, yeah, our company's it's not about the health, whatever it is. So I think we'll have to wait and see, look at Pepsi's earnings, look at Coca-Cola's earnings, and really see if Ozempic and these types of drugs are having impacts on the companies. Because certainly the market is appearing, it's looking like the market is saying that it is. I mean, you look at Coke stock from $63 a couple months ago to $53 today. That's a huge move in a company like Coca-Cola, again, whose stock is supposed to be more stable, not supposed to have these volatile moves to the up and down side. All right, another stock I wanted to talk about today is DraftKings, ticker DKNG. So DraftKings, of course, is one of the leaders in online sports betting here in the United States and across the world. And the stock has been rallying pretty hard since the start of the year. I mean, we were at $11 on DraftKings to start the year, up to above $30 right now. So almost a 200% increase from those lows that we were at the beginning of 2023. Now the question kind of becomes, is this stock running out of steam, or are we going to continue to see this uptrend swing higher, make new highs, get up to around this $48 level where we were trading at fall of 2021 before the market and growth took a huge crash? So I personally, like, I don't love the industry necessarily. The sports betting industry just as a whole, because I think you're facing a lot of different regulatory concerns across the map. I mean, it's not even legal in every state yet, or not even federally. I guess it has to be like federally legal, but I don't really know how it works. In the sense that they have to go state by state and seek approval. And I think what's going to happen is over time, we're going to start to see some of the more, I guess, negative, because the positive impacts from legalizing gambling are clear. Basically, the rationale behind it is that people are going to bet anyway. Before betting was legalized, before sports betting before I could get on my phone and bet on one of the MLB playoff games tonight, I could go to a bookie that wasn't legal, whatever. I think a lot of the rationale behind it was states basically saying, okay, if people are going to bet anyway, we may as well make some money off of it. So the positives are that, or I guess the positives from the state's point of view is that they're raking in some of these taxes from betting earnings. But again, I think it's going to take some time. You're going to start to see some of the more negative impacts of gambling, and we'll see if what I foresee happening is kind of similar to what we've seen in like the alcohol industry, is that it'll remain legal. I don't think prohibition is basically ever the move in anything. I think it's basically proven to not be that effective. But I think you'll probably start to see more and more regulations on things like advertising and promotions and things like that. Because I'm sure what's going to happen is you're going to have a lot of people assert that like some of these promotions or advertising campaigns, etc., are kind of, I don't want to say predatory, but like, I mean, look, if you're like a broke college kid, 21-year-old kid, and you see a thing saying like, hey, $500 if you bet 100, and you've never bet before in your life, and then now all of a sudden you do and you're hooked on it, then like, yeah, it's probably not great. And it's probably like the same thing as, when alcohol and cigarette companies were specifically targeting younger people because they know, hey, if we get a 18-year-old hooked on this stuff, then that's going to make us a lot more money than getting a 50-year-old hooked on this stuff. So, just something to think about with the gambling industry. I think there's going to be a lot of questions about it as we move forward. And is this good for society? How are lawmakers and regulators and stuff going to handle these things? Because again, right now, I think it's all fine and dandy, but always kind of a slippery slope with these things. With that said, I do think the betting's been very, very strong this year, just numbers wise on, football, all these things. You can see the stock coming up here. The other thing too is that as people get worried about some sort of, recession, economic downturn, vice stocks, I mean, particularly gambling stocks, casinos, you name it, tend to actually hold up pretty well, which might go against conventional wisdom because you might think, okay, well, if people are making less money or they're trying to save more money, they're not going to spend as much at the casinos, and that's typically true. But if money's tight, hey, some people like to roll the dice. That's all I'm going to say. I hate, by the way, like, I don't know, I love the casino and having fun with it responsibly, but it always bums me out, man, when you see someone at the casino or you see someone gambling and you can tell that they're not really doing it responsibly. Maybe they're gambling with a little bit of money that they can't afford to lose or a little bit of their rent money, whatever it is. And it just makes it not fun for me and kills it. It's like, I never want to, do that. Take a look at Apple here. I mean, we talked a lot about Apple last week with some of these concerns about the new phone. Apple stock actually got crushed all the way down below 170. Now it's back up to 180. You can see kind of these are the daily charts. A big winning streak for Apple here, up to about, again, 180 a share. I think we'll see if we can get back up to 190, another $10 here on the chart. If not, I mean, you're still making lower highs here. If Apple were to dip reverse right here and start moving lower, you're still seeing lower highs. You can kind of see that trend line. Again, this is on the daily chart starting back from August 23rd. So if it breaks this trend line, if Apple can break this trend line and start moving higher and making new highs, then maybe I like it on the upswing. But until then, I'm not really convinced, and I'm not sure the market will be until we get more data from the new iPhones and things like that. But you can kind of see right here, we've been on an uptrend basically all year in Apple since, let's see, go back to January 2023 up until this point. And there's basically been only two major trends on Apple all year. And So right here, I mean, this is basically what 183. If we break up here, if we get it to 182, 183 in the next couple days, I will trade Apple to the long side because I said this last week, and I'll say it again. That any sustained dip on Apple to me, whether you're talking about a 5% drop, whether you're talking about a 10% drop, whether you're talking about, like a 30% drop like we saw here, I see that as a buying opportunity on Apple. It is just too big of a company with too big of a stranglehold on the global tech industry. Not just phones, it's not just laptops. The entire global world tech industry, Apple has a giant stranglehold on a percentage, on a portion of that. I am just willing to buy Apple on any dips. It's again, like, I don't know. Nothing in investing is that easy. Nothing is that simple. I'm not saying it's oh, that, like, whatever, all you have to go do is buy Apple and you'll be great. Historically, yeah, if you've done that over the last 15 years, bought Apple on every dip, then you're in great shape. Right now, with the current market outlook, with the current, kind of moving forward, like, to me, it's just a no-brainer that if Apple's down 10%, that you can buy it, and maybe it'll go down another 10%. I mean, look right here. If you would have waited after August till Apple went from 175 down to 157 and bought right there, you would have gone all the way down to 138. The reason I say this, the reason that I like that strategy is because I can be a long-term holder, right? Like, and if you're out there younger in our audience, I know most people, I know we got people of all different ages watching. If you're, younger, you have the liberty of buying a stock, watching it go down another 20%, and just being okay with it and holding it. If you are close to retirement and you're, mostly worried about, just being able to, yeah, Sydney, that's in the, oh, AB opening a fruit stand for Apple. Yeah, exactly. I would love to. First, a fruit stand. First, we're going to open a fruit stand, and then we're going to open a fund. So if you would like to invest in either of those two things, let me know. We're going to start by raising money with the fruit stand and then the fund later, depending on the success of the fruit stand. Or if you guys think I should do it the other way around and open the fund first and the fruit stand later, we can do that as well. Just let me know. Just let me know. We'll make it work. And if I do open the fruit stand, everyone will get some sort of a discount, maybe like a free papaya or apple with every purchase or something like that. What's Hershey's stock ticker? Should we try to put a little spooky Halloween trade on Hershey's, HSY? This is another one. I was talking about Pepsi and Coke and all these staples getting beaten up. I mean, just look at this. Bam, baby. From 278 down to 195 on Hershey's. Are we going to get enough Halloween sales to start bringing this thing back? I got to get my man Edwin Dorsey back on the show. Edwin Dorsey dropped a short report on Hershey's a while ago, which interesting to me because I think you typically don't see short reports on stocks. Like, I mean, I feel like I see more short reports or short, market analysis on like growth stocks, basically saying, hey, this stock is way overvalued, right? Like stocks like Tesla saying, hey, there's no reason for this valuation. Here's why. Here are all these problems underlying the company, etc. It's more rare to see a short report on a type of staple, more stable stock like Hershey's or you're just less likely to get that big move down or you're just less likely to get that big move to the downside. So if like a lot of short report authors, you're going out there and like buying puts on the company or whatever, you're almost better off doing it on growth stocks, etc. But Edwin's thesis was really interesting, and part of it at least was the fact that Mr. Beast with Mr. Beast's new chocolate bars I think they're called like Feastables or something, are cutting into Hershey's market share, which I haven't looked into this. I haven't looked into Hershey stock or really that short report that Edwin did that closely. But to me, like that, if that is the case, if that is what's at hand here going on, is that Mr. Beast chocolate is taking away market shares from Hershey's, that is a big deal. Because I think why maybe it's not a big deal in a vacuum for yourself or for Hershey's or whatever. But why I say it's a big deal is because I think that would kind of signify, at least to me, at least in my head, a shift of like, hey, like the times they are a changing that now today a YouTuber can be so popular they can put out a product and impact the sales of a multi-billion dollar company like Hershey's. Hershey's a $40 billion company. Hershey's been around for goddamn who knows how long. Let's see. Beyond its namesake, the label, the firm's mix has expanded over the last 85 years and now consists of 100 brands, including Reese's, Kit Kat, Kisses, Icebreakers. Hershey's products are sold in about 80 countries. So I'm not saying I'm not giving credit to that thing specifically. There's probably a lot of things at play here. There's probably a lot of Ozempic fear. But again, if it is true that even in a small capacity, Mr. Beast, this YouTuber, is taking away market share from Hershey's, then I do think that starts to signify kind of like a shift toward a newer type of economy, that people like that can have that impact, that it's not just these big boys like Hershey's and billionaire companies that rule the day and that no one can ever touch them. So I'll do that before the next show. I'll dig a little bit more deeper into this Hershey's story, into the Mr. Beast, into the Feastable thing, see if that is what is going on here, and if it's, I think probably if I had to guess, it's probably like 80% Ozempic fear is why Hershey stock is down so much. And then, I think the staples too tend to get hit when interest rates start to get too high. And you can see that in kind of some other of the staple stocks that we talked about, Coke, Pepsi, et cetera, have kind of all been crushed. All right, guys, we've only got a few minutes left. At noon, we will be debuting one of our Raz reports, so make sure to stay tuned for that. Stick around and watch it. It'll be Steve Kirk from Robinhood, so if you guys want to learn more about kind of some of the things Robinhood's doing and some of the things that you can use, some of his insights you can use as takeaways for retail investors. I mean, I still personally use Robinhood for my trading, so Steve's always got some good insights for retail investors. This stream will redirect you to that Raz report. Again, going to start here in about 5 minutes, so you don't need to go anywhere. Just make sure to stay tuned, and you'll be automatically redirected. Other stocks. So, okay, just the theme of today's show, obviously, besides talking about how the market is kind of ripping despite this new war going on in the Middle East, has been, we've been just talking about a lot of different beaten down stocks. One beaten down stock that I've talked a lot about on the show before is Ulta Beauty. Ulta Beauty and Elf Beauty, the two kind of leading, at least in the stock world. You have Estee Lauder as well, but I feel like Elf and Ulta have been getting more attention from the stock world. In the cosmetic space, have been getting just chewed up. Here's Estee Lauder's chart. I mean, Estee Lauder, has been getting chewed up more than the rest of them, going from, let's see, all the way from about 380 a share, 375, all the way down to 140. So this thing has been more than cut in half, Estee Lauder. Ulta and Elf haven't been hit like that, but they've still been hit over the last 3 months. Ulta Beauty was trading at $560 looking back in June, and is now down to 390. So this is a significant drop in the stock. I like these stocks right here. Basically, the thesis is that I think what you will see is that if we do get an economic downturn type of recession type thing going on right here, you probably will see consumer spending habits start to shift in these stores. Maybe people will start opting away from the most expensive face wash they were using, or the most expensive face cream they were using, or, the most high-end name brand makeup, etc., all these things, and instead start to kind of value shop a little more. With that, so my thesis is basically that I think the spending in the cosmetic space will stay. We've talked about this before with the lipstick index. This was a term coined by Leonard Lauder, chairman of the board. Estee Lauder used to describe increased sales of cosmetics during the early 2000s recession. So again, I would anticipate to see some sort of consumer habits shifting in these stocks, but I think they'll stay strong. And then I'll say from a long-term investor perspective, I think the industries have just been growing so quickly over the past 20 years, and especially kind of one big thing that's propelled the cosmetics industry forward has been the rise of like YouTubers and influencers and things like that, a lot of whom make videos on here's how I do my makeup, here's my skincare routine, etc., making these things a lot more just prevalent than they would have been. I don't want to say it's a fad, but I think there's always shifts in what's popular. So is it possible that in 10 years it's not looked out, kind of like more like looked down upon to do all this stuff and put on this much? Maybe the trend will be more natural faces in 10 years. I don't know. I don't personally like. It seems like, I don't know. Either way, it seems like Ulta and e.l.f. sales are doing great right now. So I'm looking at it as it more of like a year-long, 6-month-long swing trade. I don't really know how I feel right now, at least about it as a longer-term investment. But all right, guys. It is 11:59 a.m. Eastern. That means it is time. We are going to wrap up EKS, Sydney, Sway, Johan, everyone who tuned in today. Thank you guys for tuning in. Make sure to smash the like. Thank you to Ryan Pannell from Kaiju ETFs for sharing some, as always, insights with us, giving us some inside baseball, behind the curtain stuff from the professional trading world. And again, next week, we're going to start doing that tenfold. We're going to make this show even better than it has been. So hopefully you guys will tune in. In fact, make sure to tune in. Otherwise, you'll be missing out on some great information. Again, Raz Report with Steve Quirk, the head of trading at Robinhood, will be starting in a minute. Do not go anywhere. This stream will automatically redirect you there. We'll be back Thursday on Benzinga Live. Till then, stay green, traders and investors. Peace.